taking a look at application of concepts from the chapter covering cash as well as internal controls. This first problem is going to be taking a look at different procedures that a company has employed in their daily operations, and we're going to identify whether it is a strength or weakness with respect to internal control principles. Remember, internal controls are any type of policy or procedure that a company puts into place that is supposed to prevent fraud from happening and to strengthen the accounting system and reporting system. So for this particular company, they have implemented a procedure where the same employee requests, records, and makes payment for purchases of inventory. Clearly, this is not a strength at all. This is a weakness because that provides an opportunity for one employee to buy inventory, make some kind of purchases for the company, and have complete control over what is bought, how it is recorded, and if it's recorded, right, and how the payment is made. So this is definitely a weakness. Really what we need to do is divide responsibilities for transactions that are related to one another, segregate duties, right? So this is definitely a weakness. In the second one, the company saves money by having employees involved in operations perform the only review of the internal controls, right? So in other words, people who are doing the work are reviewing everything. Okay? Again, that is a weakness. One of the strengths of having auditors come in or having internal auditors come in, somebody who doesn't work in that area, is it provides independent reviews, checks and balances to make sure that not one employee has control over everything and that employees aren't able to kind of cover their tracks, so to speak. So this is absolutely a weakness. We need to have this company improve that by performing regular and independent reviews, right? That's the key. We don't want somebody working in that area to be doing the reviewing and checking. In the third one, time is saved by not updating records for use of supplies. Okay? That's a weakness. One of the internal control principles is maintaining adequate records. In other words, keeping track of the assets. We don't want to just not know what the amount of supplies that we actually have is. We need to keep records of the supplies that are used. So we do need to make sure records are used and updated regularly as supplies are used. The record keeper is not allowed to write checks or initiate electronic fund transfers, EFTs. This is a really good control, right? We are segregating the duty of whoever has the capability to write checks or the custody of the cash, custody of the assets, with the ability to record, right? If this was not segregated, the person keeping track of the cash could just spend cash, right, and record it themselves, and nobody may catch the fact that they're spending cash on some non-business related cash or item, right? So this is a good strength to have two different people doing these two different steps in the cash payment process. Finally, each sales clerk is in charge of her own cash drawer. Okay? That is a strength because if we have one cashier responsible for all the cash in that drawer, we are establishing responsibility with who we can hold accountable if cash goes missing, right? If there's any kind of discrepancies. So that is absolutely a strength. It is good holding somebody accountable. They're responsible for that cash drawer. All right, another area in this chapter that we looked at was the accounting for petty cash. This example, exercise 8-8, is going to look at how we record transactions related to the petty cash fund. While Paca Company establishes a $350 petty cash fund on the 9th of September. By the end of the month, the fund shows $104 in cash. In other words, there's $104 cash left in the fund. along with receipts for transportation in, some kind of shipping cost, postage cost of $123, miscellaneous expense of $80. The petty cashier could not account for a $3 shortage in the fund. We are going to prepare the entries first for the establishment of the fund on the 9th of September. Prior to pulling $350 out of the bank to put into this petty cash fund, which I want you to think of as sort of a lockbox, all of the cash is kept track of or recorded in the main cash account in the general ledger. If we are removing some of the cash out of the bank, we need to show in the general ledger that some of that cash is no longer in the bank, which we keep track of in the cash account. Some of it is actually in a petty cash lockbox. So we are going to shift the amounts in the general ledger out of the main cash account with a credit, and we are going to put it into a different cash account in the general ledger, an account called petty cash. These are both cash accounts, so we have not changed the amount of cash that is recorded in the general ledger. The company still has the same amount of cash, it's just located in two different places. Okay, so we're decreasing one cash account, increasing another. On the 30th of September, throughout the month, some of that cash of $350 was used to pay transportation in, so they must have bought some inventory and had to pay the shipping on it, which adds to their inventory cost. They had postage expenses and miscellaneous. Prior to this entry to reimburse the fund, we had not recorded any of these cash expenditures in the general ledger, because as the cash of the company was being spent, receipts were just thrown in the lockbox, cash was taken out of the lockbox, right? So none of this has been recorded in the general ledger. So when we go to reimburse the petty cash fund, the first thing we need to do is figure out how much cash do we need to pull out of the bank to reimburse this fund. And the easy way to do that is to look at the amount of cash that's currently in there, which is $104. We need to get the cash in the lockbox reimbursed up to $350. So I am going to take $350, subtract out the amount of cash that we still have. $246 is the amount of cash that is gone from the fund. That's the amount of cash we need to pull out of the bank to put into the lockbox. So we will credit cash, $246, pulling another $246 out of the bank, decreasing our main cash account. We are then going to record everything that cash was spent on. Transportation in for the inventory purchased. Okay. Remember, transportation in costs for inventory as we ship it to us is included in the merchandise inventory account, which we learned back in chapter 5. So we are debiting the merchandise inventory account. We are crediting postage expense for the amount spent on postage cost, miscellaneous expenses. At this point, we know we have credited $246 from the cash account. If I add up all of the expenses that were paid, I come up with $243. The problem already told us there was a $3 shortage. The amount of cash missing is greater than the amount of cost expenses that were paid. So to make this journal entry balance, we need another $3 debit. That would bring my total debits up to $246, which would agree with the credits. The account we use is what I affectionately call a plug account. We use this account, we can debit it or we can credit it for whatever we need to make the journal entry balance. Here we are debiting that account to balance my reimbursement. And when I am debiting the cash over in short account, I am essentially creating an additional expense, additional cost. If this account is debited, it's an expense. We have an additional expense cost because we were short $3. If this account had been, if we were to slightly shift this problem, let's say instead of there being $246 that had been spent out of the fund, what if there was only $242? that was missing from the fund. Okay, at this point, if I total up all of my debits, they total 243 and my credits total 242. In other words, the amount of cash spent was 242 to pay $243 worth of expenses. That means I was not short on cash. I was over on cash. I had $1 more than I should have. So to make this journal entry balance, I needed another $1 credit in that account. And that credit, when I credit that same plug account, cash over short, means this account with a credit balance is acting like an additional revenue, additional source of income. So this credit increases my profits because the account is acting like a revenue. Before, when we had just debited it, the account acted as an expense, right? So again, this is kind of like what I call a plug account. It's kind of like a little chameleon account. It can be an additional expense or an additional cost, or it can be an additional revenue. Okay, it just depends on whether we debit or credit that account. All right, finally, the last transaction they want us to record is on October 1st, they decided to increase the petty cash fund from a $350 set amount to $400. Evidently, they thought there wasn't enough cash in the petty cash fund, so they're adding another $50 to it. So our journal entry in the general journal is to show that we're taking another $50 out of the main cash account, out of the bank, and putting it into the petty cash fund. So again, the only time we are doing anything to the petty cash fund in the general ledger is when we ultimately are establishing it or changing the fund balance. Every time we are recording the costs or the expenses, that is affecting the main cash account. So this is where we see the company's total overall cash decrease. The other part of this chapter is looking at bank reconciliations. Okay, and bank reconciliations are a significant internal control. It is a verification, an independent review of all of the transactions that were recorded in the cash throughout the month. So when we get a bank statement at the end of each month, the bank statement shows all of the cash transactions that affected the account at the bank side, and then we compare that to the transactions that affected cash in the general ledger or the book side. Okay, so when we're reconciling, there are going to be things that one side has recorded that the other side hasn't. There's going to be things that the books or the general ledger had recorded that affected cash, but the bank hadn't yet recorded it. Or there are going to be things that the bank had recorded and reflected on the bank statement, but we hadn't recorded in the general ledger yet. And those are called reconciling items. And in this exercise here, we're going to take a quick look at some common reconciling items or common things that reflect differences between the bank and the book balances. Okay? So what we're going to ask ourselves is whether each of these is affecting the book or the bank side of the reconciliation. And we are going to also look at, will this be added to or subtracted from that side? And is it going to require us to prepare a journal entry? Okay, so for example, interest on a cash balance. The way we find out about interest on our cash balance is when we get the bank statement, right? Up until the day we get the bank statement from the bank, we do not know. We have not recorded any amount related to interest that the bank has paid us for the cash we kept in the bank, right? That means we have not recorded it in the general ledger yet, but the bank had already recorded it in the bank's books. So to identify which side of the reconciliation this will be reported on as one of the reconciling items or one of the things that cause the difference between the two balances is we ask which side hadn't recorded this. Interest on a cash balance. The books had not recorded it yet. So the amount of the interest is going to be reflected on the book side of the reconciliation. Now that we know that we have earned interest, we are going to be adding the amount to the cash account in the general ledger. And because we have not recorded it in our accounting system, it will require us to prepare a journal entry. So an entry will be required in the general journal to post into the general ledger. Bank service charges. Anything a bank charges us for providing a service for us, we do not always get a notification from the bank. So the only time we find out about some sort of bank service charge or a bank fee is when we get the reconciliation. Which side hasn't recorded it? The book side, because the books did not know that the service or the expense or the fee had occurred. So that bank service expense, or excuse me, bank service fee is going to be reflected on the book side of the reconciliation. And now that we know that the bank had charged us a fee, we are going to need to subtract it from the balance on the book side. And now that we know about it, we do need to record it in the general journal to post into the general ledger because we hadn't previously recorded that our cash was used to pay that fee. So an entry will be required. It's the same concept with the minimum balance bank fee. Banks often require we as individuals as well as companies to maintain a minimum balance. And if we fall below that balance, they charge us a fee. Just like with a service charge, we don't always know that these fees were charged to our account, that our cash was used to pay those fees. The bank already recorded it. The books had not recorded it yet. So it has not been recorded on the book side, so this reconciling item will be reflected on the book side of the reconciliation. And now that we know that this cash was pulled out of our account, that some of our cash was spent to pay that fee, we will need to subtract it from the cash on the books, which requires a journal entry. We need to record it in the general journal to post to the general ledger to decrease cash in the general ledger to reflect this bank fee charged to us. Outstanding checks. Outstanding checks are checks that the company wrote to pay somebody something we owe. We wrote the check. When we wrote the check, we decreased cash in the general ledger in the books, mailed the check, but the check has not been deposited into the bank by whoever we sent the check to. That means it is still outstanding from the bank side. The bank has not yet processed that check. They have not yet pulled that cash out of the cash in the bank. So which side hasn't recorded it? The bank has not recorded it. So it will be on the bank side of the reconciliation. What will the bank do once they learn about these outstanding checks and process them and pay them? They will subtract that amount from the balance in the bank. There is no entry recorded in the general journal to post to the ledger because it was already recorded at the time the check was written. So there's no additional entry required in the general ledger. Collection of a note by the bank. The bank collected a note receivable on our behalf. So we have a note receivable in our general ledger in our books. Whoever that amount was owed to us by has paid the bank directly. The bank collected. Which side hasn't recorded this collection? The books had not recorded this collection because the books did not know that that collection had occurred until we got the bank statement. Now that we know that this has been collected, we will need to add to our cash on the book side. Because the amount was collected, our cash needs to increase. It will require us to prepare a journal entry in the general journal to post into the general ledger to increase our cash. And F, NSF checks, stands for insufficient fund check. Customer sent us a check. When we got the check, we increased cash in the ledger because we thought the customer had paid us, and then we deposited the check into the bank. The bank went to get that cash from the customer's account, but the customer had insufficient funds. They never put that cash into our account because we never actually were paid. So which side has not recorded that those deposits had been insufficient funds? The books. So this reconciling item is going to be on the book side of the reconciliation. Now that we know that cash was never received, we need to subtract that amount from the balance in the general ledger, cash. And it will require us to prepare a journal entry to do that. Deposits in transit. Those are deposits that are somewhere between the company's and the bank account. For example, it's the end of our day. We get all the cash receipts for the day. We add them all up and we record the cash deposit in the general ledger. And then we go deposit that cash in the bank night depository or in the ATM. But the bank is closed on that day. And that happens to be the day that the bank statement closes. The deposit will not be made until the next day by the bank when they process that deposit, and that next day will go on to the next bank statement. As of this bank statement date, this deposit in transit had been recorded in the general ledger, but it had not been recorded by the bank. So the bank had not recorded that deposit. It will show up on the bank side of the reconciliation. Once the bank finds out about it, they will be adding that cash to the balance in the bank. So we will be adding it to the bank balance on the bank side of the reconciliation. Will it require us to prepare a journal entry? No. That deposit was already recorded in the general ledger. We do not need to record it. It's already in our cash balance, not in the bank balance. That's why we don't record it in the books. The bank will take care of it when the bank processes the deposit. Using those thought processes that we just worked with in that exercise is going to help us as we are doing this reconciliation for the branch company. The following information is available to reconcile branch company's book balance of cash with its bank statement cash balance as of July 31st. On July 31st, the company's cash account has a balance of $27,497 and its bank statement is showing $27,233. On July 31st, we are going to reconcile the bank balance to the book balance and try to explain why these two balances do not agree and reconcile them. The first thing that was identified as one of the causes of the difference between those two, check number 3031, 3065, and 3069 are all outstanding as of July 31st. What does this mean? This means that the company wrote all these checks. When the checks were written, they decreased these amounts from cash in the general ledger, sent the checks to whoever we were paying. But as of July 31st, whoever these checks were sent to had not deposited them and the bank had not processed them. The bank had not taken those amounts out of our account. That means these have not been recorded by the bank. So we know these amounts are going to be on the bank side of the reconciliation. Once the bank processes them, they will be subtracting those from their balance. So we will show as a deduction from the bank statement balance these three outstanding checks, which in total are $4,145. Next item, Check number 3056 for July rent expense was correctly written and drawn for $1,270. But when it was entered into the accounting system, it was erroneously or incorrectly recorded at $1,250. We should have been decreasing cash $1,270, but when we entered it into the accounting system, we decreased it for $1,250. We did not decrease cash enough. There is an error here. Which side is this error on? This error is on the book side. The bank correctly decreased cash in the bank for the amount the check was written for, but it was recorded wrong in the books. So we know that this error is on the book side of the reconciliation. Does cash need to go up or does cash need to go down as a result of this error? We need to decrease cash because we didn't decrease it enough. We decreased $1,250, it should have been decreased $1,270. So we are going to be deducting from the book balance another $20 from our cash to correct that error. The July bank statement is showing the bank collected $7,955 cash on a note for Branch. Branch had not recorded this event before receiving the statement. The bank collected a note receivable for the company. The company currently has a note receivable in their general ledger for $79.55. They did not know that this was collected. So which side has not recorded this collection? The books. So we know we're going to be on the books side of the reconciliation. Now that we know that this collection occurred, we need to add that to our cash. So we are going to add the proceeds from the note collection of $79.55 to our book balance. E, the bank statement shows an $805 insufficient fund check. The check had been received from a customer, Evan Shaw. Branch has not yet recorded this check as insufficient fund. We received the check from the customer. We thought the customer paid us, so we increased our cash and decreased accounts receivable. The bank went to collect that cash to put it into our account in the bank, but they didn't because there wasn't enough cash in the customer's account to pay it, to give us that money. Thus, which side has not recorded that deposit, that check was insufficient funds? The book. So we know the books have not recorded it. We are going to be on the books side of the reconciliation. Now that we know that that was an insufficient fund check we received, we need to decrease it out of our cash on the book side. We should have never increased cash for receipt from the customer because we didn't really get paid. F, the July statement shows a $25 bank service charge. It has not yet been recorded in miscellaneous expenses because no previous notification had been received. We found out that the bank had taken $25 out of our account to pay for a service charge. We found out about it when we got the bank statement. We had not previously known about it, so we had not previously recorded it in the accounting system. Which side has not recorded this? The book side. So we know this reconciling item is going to be on the book side of the reconciliation. Now that we know we were charged $25, we need to deduct that $25 from our cash in the general ledger. Finally, on the last day of July, daily cash receipts of $11,514 were placed in the bank's night depository on that date, but they did not appear on the July 31st bank statement. That deposit was made by the company after the bank closed, and the bank did not process it and record it in our account. Which side has not recorded that deposit? Which side has not recorded that increase to cash? The bank. Once the bank finds out and processes it, they will be adding that deposit to our balance. So we're going to show that as an add to the bank balance. All right, we have accounted for or identified and put into our reconciliation all of these things that the company identified as reconciling items or causes of the differences in those two balances. Now we keep our fingers crossed that we did it right. We take the balance on each side, add to get to a subtotal, subtract to get to a final adjusted balance. Do it on the book side. Balance, add to get a subtotal, subtract to get an adjusted book balance total. If we did it correctly, these two balances will agree. These balances reflect what both sides would be reporting as the balance on July 31st if both sides had recorded everything that happened that affected cash during the month. Okay. The reason both sides are not reporting that amount is because there are things that happened that each side had not yet recorded as of July 31st. Okay, and so these are the items that each side has not recorded. Okay. The very last step is, now that we have reconciled, we need to prepare journal entries to make the company's book balance equal to the reconciled cash balance as of July 31st. When we get to this step of the reconciliation process, we can ignore everything on the bank side of the reconciliation. There are no journal entries required. All of these items have already been recorded in the general ledger. Nothing else we need to do. The bank will take care of them in due time. But all of these items on the book side of the reconciliation, none of these have yet been recorded in the accounting system. They need to be recorded now that the company knows about them. So, the easy thing about this is we know that every single one of these amounts will be affecting cash. And the reconciliation is already telling us how they are affecting cash. Cash is going to be added or increased by $79.55. Cash is going to be deducted or decreased for these amounts. The order doesn't matter, but I'm going to start with this first one. I am going to add $79.55 to the cash account. Right away I know to add to the cash account, I will be debiting it. So I will be debiting cash $79.55. Why am I debiting cash $79.55? Because the bank collected on a note receivable for the company. If the bank has collected on a note receivable, my note receivable needs to decrease. So cash will be debited to increase, notes receivable credited to decrease. All right, got that one recorded. Let's go to the next reconciling item. Insufficient fund check. I know I need to deduct or decrease or credit cash for $805. So I will credit cash $805. Why am I crediting cash $805? Well, because a customer had given us a bad check. So at the time we received it, we decreased accounts receivable, thinking the customer had paid us, but the customer really didn't pay us, so we're going to put it back into accounts receivable and continue to collect from the customer. Okay. So we are going to debit accounts receivable and credit cash. Sorry, I don't know why that thing is there. We'll make that go away. Okay, we have now dealt with that one. So we have now taken care of this one and this one. The next thing we need to record into the general ledger is the service charge. And I know I need to deduct or decrease or credit cash for $25. So going to go down here and I am going to credit cash for 25. Why am I crediting cash 25? Well, because the July statement showed a bank service charge that had not been recorded in miscellaneous expenses because we didn't know about it. Now that we know about it, we will record it into our miscellaneous expense account, increasing our expenses, decreasing our cash. All right, finally, the last thing we need to record in the ledger is a decrease to cash of 20 due to an error in a check we wrote. So we know we need to decrease, credit $20 to cash. So I'm going to be crediting cash 20. And what else is affected? Well, there was an error. Let's go see what the error was. Oh, it was back here when we paid July rent expense. We wrote the check for $12.70, but when we recorded it into the accounting records, we only decreased cash $12.50 and only recorded $12.50 of rent expense. But we know the amount of cash spent and the amount of rent expense incurred was $12.70. So cash was decreased too little, so we're decreasing cash another 20. We also decreased rent expense too little, so we need to debit the rent expense to record the additional $20 in expense that we actually incurred. Hopefully this helps with understanding how to prepare a bank reconciliation and emphasizing that the only things that we need to prepare entries for are things on the book side of the reconciliation. All right, time to go do your homework.